Hello and welcome to my video. I'm Shady Josh on Twitter and I've just started a new YouTube channel called Lemonade to the Moon. I'm holding the baby so she doesn't cry.
We babies are having a crisis.
Oh no! That's awful! Horrible! What is it?
Well, it's simpler if I just show you. Teddy, if you please.
Let's put on a show. Here we go.
Jimbo, hit the lights.
Lemonade sells a pet insurance product and it's direct to consumer and it is just an outstandingly good product in my opinion. I've been doing a ton of research and I wanted to share that with the community and explain why I believe that Lemonade can make billions of dollars. So one stat I found out is that the market penetration for the whole of the US is only 2%. And that means that there is just so much room for Lemonade to grow, competitors to grow, new entrants to grow, and there's still a ton of room for everyone to make a load of money. Lemonade's loss ratios are improving very quickly over time, so we'll look at that. We're going to assume that Lemonade has 200,000 customers. I found some very recent research that shows that there is about 203,000 customers, so 200,000 is conservative, but it just makes the math a bit easier as we go through, because I'm going to actually walk through some mathematics behind a model that could underpin our understanding of the pet insurance class of business. I will also assume a 75% gross loss ratio, and that's just an easy, it's an easy assumption to work with. We had 77% at Q3 2023, so it's not a huge stretch. Let's get into the slides. Let's look at what Maya had to say at the Lemonade Investor Day, and let's just go right through it. Thanks for watching, and if you do enjoy this content, of course, hit subscribe and press like. And I'll see you at the end of this video.
You see, babies aren't getting as much love as we used to.
Why? Have we been bad?
No, Stacy, but I'll tell you who is. Behold our mortal enemy, puppies.
Aww.
No, that's exactly the problem.
Puppies? What's the deal with puppies?
Throughout history, people have loved babies more than anything in the world. We've always been a must-have item, number one on every wish list. Puppies were merely accessories. But all that changed when the puppies began coming out with new designer models, each one more adorable than the last. Remember the Labradoodle? The Peekapoo? The Chewini? Try to say Chewini without smiling.
Chewy!
Not possible, don't waste your time. We all laughed at the Shar-Pei. And now it's #1 in China.
Oh no! That's terrible! Horrible!
Yes. And it gets even worse. Francis, the CEO of PuppyCo, made this announcement. Teddy, roll the clip.
And we are on schedule to release the most adorable puppy ever. We're going to launch it at the pet convention in Las Vegas. Watch out, world. It's gonna crush the competition.
Yay! No, Jimbo. No yay. We are the competition. This is war. Puppies are winning, and babies are losing. Thank you, Teddy. And if this new puppy is as cute as we fear, it could put the baby business out of business, baby.
That's all bad news, baby.
Over the last couple of decades, in most Western nations around the world, birth rates have plummeted. Young people, young families are just not having as many children as they were before. And puppies have filled that void. Over the last 5 years especially, we've seen a huge growth in the number of pets in our homes. That provides a huge growing marketplace as more and more people get pets. They are particularly younger people and they're not insured. We know from the stats available that only 2% of pets in the US are insured. So Lemonade's pet product is being sold into a really fast growing, developing marketplace. Pet is a direct to consumer product and it's sold via the app in a very fast growing insurance market. There's very little competition relative to other classes, and Lemonade has around 200,000 customers as of Q3 2023. This is a highly profitable, predictable class of business with extremely low market penetration. Lemonade has a current gross loss ratio of 77%, but we're going to assume 75% going through the rest of these slides. This slide shows the actual gross loss ratios over time as of Q2 2023. And it shows that for pet we've got a pretty steady decline over time, which is very encouraging. We want to see pet to be established as a real core product for Lemonade. I believe that over time we will see the product generate a 60% gross loss ratio. And I think that's borne out by the chart and by experience, and also from the Q3 2022 Investor Day presentation, where it was explained that the current cohort of insureds was expected to run at a 60% loss ratio. Let's cut to that clip and have a look at what Mo had to say.
And the numbers show this. Numbers for pet insurance are looking really great, but the number that I want to focus on might be less obvious, and this is the number of claims. We've had 450,000 pet claims in the past 2 years. The reason why we love pet insurance and why this number is great for us, it's because pet is one of those products that has a really low severity and high frequency. This is a product that is meant to be used. You're meant to be taking your pet to the vet a few times a year. This is how we price the product. And so every time you do that, we learn more about you and your pet, and we're able to price and underwrite these customers better. Let me show you how our pet claims look as opposed or comparison to all of our other products. The pink line is all of our pet claims, and the gray is all of our other products combined. It took us 7 months to reach the same number of claims we had in home in pet. Just think about that volume. So it helps us with loss ratio, it helps us with pricing, it helps us with underwriting, but it also helps us, might not be as intuitive, with the cost of handling claims. The more claims we get, the more opportunities we identify to inject technology and automation in the claims handling. And so when we just launched pet, 36% of our premium went to the cost of handling claims. We're already down to 14% with a clear path by the end of next year to reach below 10.
Maya is making a very, very important point here. The stability of the claims is the key fundamental that is going to allow pet and renters insurance to fund the growth of the company for decades into the future, and I will explain why that is the case in a few slides coming up. The central limit theorem is a fundamental principle applied in the insurance business, and what it says at a basic level is that as you have more and more observations, the variance tends to the underlying population variance. So for example, if I was to flip a coin 2 times, the variance of outcomes would be quite high. I could see like 100% heads or 100% tails or some mix of heads and tails, right? If I was to flip a coin 10,000 times, the likelihood of having 10,000 heads is like 0, or even more than 52% heads is very, very low. But if I was to flip a coin 10 times, then the likelihood of having like more than 52% heads is quite high, right? So as the sample size increases, the variance tends to the underlying distribution variance. And that is a core principle that's used in insurance. So we pull risks because of that principle. So as an example, if we have a small insurtech which sells 1,000 pet policies, let's say the total premium income is 500,000, so the average premium is $500. Let's just say, for an example, that the probability of the aggregate losses for that portfolio exceeding 500,000, i.e. the loss ratio being 100%, is 10%. But now let's say the insurtech grows over time and then sells 100,000 policies. So they've grown the volume of the business 100 times, and all else being equal, the portfolio at that point would have a much less than 10% chance of seeing a 100% loss ratio. And again, that comes back to this central limit theorem. So by definition, mathematically, it has to be the case that as the portfolio gets 100 times bigger, the loss expectation, the variance of the expected aggregate loss amount has to be much lower. Touching very briefly on this slide, this shows the collective risk model, which is quite widely used to look at the mean and variance of an aggregate loss model. So for Lemonade Pet, we have, let's say, 200,000 policies, and at the end of a year, we have had so many claims, right? Let's just say, for sake of argument, that the best estimate is that we have 60,000 claims, and then on average, all of those have some average, like 1250. So we have an aggregate loss amount of $75 million. But of course, we know that there's variance around that. So this slide just shows a model. So explaining it a little bit. So this is the expectation of S, which is the aggregate loss model, and it's just saying that the expectation of S is the expectation of all of these individual XIs given N, which is the number of claims. And again, N is an independent random variable, and all of the XIs are also independent random variables. And the mean is mu, which is average of the XIs, the claims, times n, the number of claims, and then the variance comes through to sigma squared n. And then these formulas you can look into elsewhere if you want. They're not really important for our discussions here, but this case we will look at a bit later on. So this is the Poisson distributed frequency. I think Poisson would probably be quite a good model for the frequency and possibly the aggregate loss costs for the pet insurance class, because it has relatively low variance. Okay, so just looking at this is a graphical representation of basically what we've been talking about. So remember that the aggregate loss costs are they are part of a big distribution, and we do not know the underlying distributions. All we know is at the end of a year, like at the end of 2024, we have a loss ratio and we have a total loss amount for pets, but we could have seen a different outcome, right? So if we were to rerun the simulation 10,000 times, i.e. if we reran 2024 10,000 times, we could have the exact same input variables and still see different loss amounts coming through, like the portfolio losses would be different every single time. So this graph is kind of representing that and saying over time, if we were to gather all of those up, we would kind of converge to this normal distribution. And on screen now is a demonstration of what this looks like. As claims come in, they will converge to the normal distribution. So more and more claims arise under the claims process, and as the portfolio gets bigger, we would expect to see more and more claims volume over time, and they will converge to an underlying distribution, and the variance reduces as the number of claims and the volume of business increases over time. So just thought I'd show that and maybe help to demonstrate it. So why does all of this matter? So the reason this matters is predictability allows us to do many things. If we think about our own situations, right? If we are employed with a good stable income every month, we have some savings in the bank, maybe we live with a life partner, and we've got some stability in our lives that enables us to take some risk. Whereas for people that are in a less stable situation, they're just less able to take risk and less able to proactively plan their approach to life, right? And especially with regards to financial things. So it's the same for insurance companies. Lemonade can really take advantage of the pet portfolio being quite stable to accelerate growth. So they can take advantage of knowing with pretty high confidence what the loss ratio of each year will be. Predictability allows lower regulatory capital, and we'll come back to this in a second. Allows a more aggressive growth strategy, so allowing Lemonade to grow into more volatile classes of business, and predictability reduces the insolvency risk. Just looking at regulatory capital for a second, Lemonade and all other insurers have to hold capital, and so Lemonade will run these simulations like we looked at in the previous slide and come up with these kind of range of possible outcomes, and then they will meet with the regulator and present their findings, and generally speaking they will recommend, or they have to use some formulas that are laid out by the regulator, but everybody will kind of agree on the company having to hold a regulatory capital amount which is equal to, let's say, for the sake of argument, the 99th percentile which is that's the number that's used in the European markets. So, in this portfolio, let's just say that for the sake of argument, the best estimate of loss for the aggregate losses is 80 million. And, we've got the range of possible outcomes here. And let's just say that the 99th percentile is $105 million. Well, then it might be reasonable to hold $105 million as the capital requirement, because in 99 out of 100 years, the losses won't exceed that amount. But now compare that to the home portfolio. This is an example that I've kind of made up, but it kind of demonstrates that, here's a mean. Let's say that this mean is $100 million of aggregate losses to the insurance portfolio. But there is a very significant chance that we could actually see, let's say, $200 million, or even 300 if we were to come over here somewhere, or maybe 400 in a really extreme example out here. So by definition, by the way that the claims arise, we know that home and motor have got much lower frequency but much higher severity, and mathematically we can model that, and it's well understood and well established that the aggregate loss cost distribution has got a much different shape to the shorter tail kind of high frequency, low severity classes like pet and renters. So what that means, and the kind of takeaway point from this slide is that for home, Lemonade would have to hold a much higher amount of capital with respect to the premium income. And so it makes pet actually a much more profitable portfolio on a like-for-like basis. Now this is a very, very interesting slide. This is a chart showing the comparison of premium by state for Lemonade with one of its key competitor. I would say its key competitor, which is Trupanion. Trupanion is a direct-to-customer pet-only insurer, so the only product they sell is pet. So I think that they are basically Lemonade's key competition in this space. I'm going to make another video about this, but I have got a feeling that one day Lemonade will buy Trupanion. Maybe not now, maybe not next year, but one day Lemonade will acquire Trupanion, and I'll talk about all of the reasons for that in another video. But for now, let's just focus on the premiums. So just eyeballing this as a quick glance, Trupanion's premiums are basically double Lemonade's premiums. And bear in mind, Trupanion is the #1 player in this market. So for Lemonade to be able to undercut them by like half and still achieve like 77-75% gross loss ratio is just outstanding, and it just shows the potential of the product. If you undercut the #1 player in a market where there's 2% market penetration, that is just very, very good. The economics are good, and we'll see later on. Actually, let's just go right now to the next slide. This is some of Lemonade's filed pet rate increases. So, like the 541, for example, for New York, we can see here that Lemonade has filed a 13% rate increase for New York and Massachusetts, 28%, and all of those states are there. And so Lemonade is proactively tackling the 77% gross loss ratio. We know that they want to achieve better than that, and they can do it. And this is how they're going to do it. One of the ways that they will achieve that is just by filing those rate increases and seeing the improved rates come through. And bear in mind, there is no competition. Like, there is no one in the pet space at all. There is, we'll see later on, there's 2% penetration. So that is that slide, just showing some of the rate increases that are coming through. And jumping down to the next slide, this is again the filed rate increases by state, and some pretty big numbers in here. Like we have got, for example, I don't know, CT, 23.7% rate increase filed in May 2023, and then the effective date is July 23. So another thing that this slide kind of demonstrates is that there is a pretty significant gap between when the rates are filed and when they are effective. So that is kind of a reason, like for example here, New York, you can see The rate was filed in March 2023, and then it actually took effect in November 2023. So that's one of the key reasons that inflation has had such a negative impact on the portfolio, because it does take some time for those rate increases to come through. And I'll do another video elsewhere to explain a bit more about the mechanics behind that. This is a very interesting slide again. So Lemonade's pet market share is around 4%. But again, the market is very small. So even though the market share is low, that doesn't matter. What matters is the growth of the market. So this was from, I'll put the source in the description, but Lemonade has reached about 203,000 pet policies, and most of those are concentrated in just 3 states. So, you know, you don't have to be a genius to work out that if there's 50 states in the USA, and Lemonade has only got, it's only got penetration in 3 states so far. It's just insane how much the market opportunity is. Like, if Lemonade goes into all of the states and gets 20% market share, this is going to be like a really, really big opportunity. Like, really big, multi-billion dollars of premium. Now, this is, again, very interesting. So we talked about Trupanion. Trupanion is, I think, Lemonade's key competitor in the space. But again, they have also filed rate increases. So we saw a bit earlier, if I just flick back, we saw that Lemonade's premiums are much, much lower than Trupanion. So you'd think that Trupanion would kind of slow down on increasing rates and pushing those prices up. But no, actually, they are increasing rates as well. And I will show a bit later on Trupanion's growth. It's been amazing. So here are some figures from Investor Day, and I'll get into some of these a bit later on. But first of all, let's switch back and just watch again the presentation from Investor Day, and then we'll circle back and talk through these numbers.
In Q3 of 2022, $25 million of our IFP for our pet insurance business came just from renters. Speaking of pet, we think about pet insurance very similarly to how we think about renters. These are younger customers. Many of them are first-time buyers of insurance. But what's more interesting is that this really creates a different relationships between us and our customers. It's moving us from insuring the stuff you love to insuring the ones you love. Our customers look at their pets as part of their family. And every time we engage with them and we pay out a claim, we create a deeper connection with them, which creates stickiness and more opportunities for us to cross-sell them and offer them other products. We're excited about pet insurance also because of its market, which is essentially a blue ocean. Only 2.5% of households with pet have pet insurance. There's a lot of room to grow. One of the reasons why pet owners don't buy pet is because of awareness and education. We've built a phenomenal product that has been able to be broken apart, and so every customer can buy exactly what they need for their pet and understand the value of what they're buying. This market is growing 25% year over year, and we're growing 4 times faster. In the past year alone, we've doubled our pet business. And we just announced a strategic partnership with Chewy, offering Lemonade pet insurance to its 20 million online customers who are already used to buying pet insurance online.
The number of pets in the US is growing over time as more and more people have cats and dogs instead of children. But in addition to that, the insurance market is growing very quickly. So the penetration so far is about 2% in the US. Over time, those young people who have acquired pets recently will buy more and more insurance products. On screen here, we can see an extract from an Ernst & Young report, which just shows the premium volume growing rapidly over time. Then coming down to the next slide here, this is the average premiums. Again, this is up to 2020, but elsewhere we do have some more up-to-date data, which shows that the premiums have accelerated beyond the 2020 data point that we see here on screen. Now, the market penetration is a really key part of this story. So in the US, we know that a lot of people have pets. there are a large number of pets in the US market, but not many of those are insured. This is an extract from a Trupanion presentation, and it shows that in the US market, when this presentation was made, there was around a 1% penetration, and I think the more recent number is 2.5% from the Lemonade Investor Day. But either way, if we think about the size of the market relative to its potential at the moment, Lemonade has just got a huge runway ahead of it. So thinking logically about this, if there are 180 million pets, and maybe there's 2 or 3 per household in some cases, but I don't know, let's assume that there's 120 million households where there are pets, and let's say that 25% of those households were to buy a pet product. That's a huge amount of policies that people could sell into the marketplace. Lemonade, Trupanion, other competitors. There's just a lot of room for everybody to grow. Now, interestingly, the UK market, I live in the UK, so it's a market I'm more familiar with. In the UK market, around 25% of pet owners buy insurance products for their pets. I don't know the reason for the discrepancy, but it's just a huge difference. So later on in this pack, I will kind of look at a model where we assume that the US catches up to the UK. So if we were to assume that 25% of the pets in the US were to be insured, we'll look at what that might mean as a market size. And then if Lemonade was to capture a percentage of that market, we'll see some really big numbers arising from those assumptions in future slides. But again, really important slide, this one, just to consider how big the market can be relative to its current size and how much opportunity that gives for growth, not just for Lemonade, but for all of the competition. There's enough space for everybody to grow very quickly over time. And again, this is a slide of the market shares from Ernst & Young. I don't know which of these Lemonade is. Maybe they're on here, maybe they're not. But again, there's a relatively concentrated market. If we think about the property casualty market, where there are like literally hundreds of insurers all competing in the same space, or the home market, those more mature marketplaces have like literally hundreds of players, and many of them only have like 4% market share. The top players only have like 4% market share in those more developed lines of business. But for pet, we can see that because it's a much newer product, a much newer marketplace, nobody has kind of cornered the market. There's not a load of competition here. There's space for everybody to grow, and there's a relatively really small number of insurance players in the market. So how is the pet product distributed? Well, generally, you can see on screen here there are a number of ways for the product to be distributed. Lemonade is primarily in the direct-to-consumer digital model, so they're using an app, and then claims are also handled through that app. But also we know that there's an emerging partnership with Chewy, which will kind of be what's known as an affiliate kind of partnership. So this, again, a very interesting slide. So Trupanion, I believe, is one of Lemonade's key competitors. This is from their Q3 2023 earnings deck. The revenue, I mean, the slide speaks for itself. You don't need my commentary. The revenue is going up and to the right very quickly. Now compare this to Lemonade's deck from the earnings, from the shareholder day presentation, where we saw that premiums had doubled in the year from 55 million to 110 million. So Lemonade is also growing very quickly in this space. Again, I'll make a completely separate video on this, but let's spend a minute or two here. I believe that Lemonade, subject to raising the capital and making it work, I believe that they might buy Trupanion, because that would cement the position of Lemonade in this space. Pet is such a compelling product because of a number of reasons. Number one, the solvency requirements are quite low because of the low variance of the aggregate loss distributions that we talked about earlier. The capital requirements are low, which means that you can accelerate growth quickly. And it's also just a brand new, in relative terms, a brand new market. A lot of the people who have bought pets are young people, so they really match the Lemonade target market, and there is so much space for everybody to grow. I believe that Lemonade will buy Trupanion one day, or maybe there'll be a merger or something along those lines. But the synergies between the two companies just look pretty good to me. So we'll watch this space. I'm going to do some more research outside of this video to really understand what that might look like. So watch this space for future videos on that. Okay, so quickly touching on some of these generic market-wide pricing considerations. We don't know the way that Lemonade prices the product. It's not something that they have released to the investor community, but these are kind of general pricing parameters that, you know, people in the marketplace generally might use. And you can look through all of those, and you know, there are some others, but these are probably the main ones. Okay, so loss trends, bear in mind that these are as of 2019, and we know that more recently we've seen significant pricing inflation increases for all products. So I would expect pets to also be included in that. But again, before the pandemic, we were looking at apparently 10 to 15% annual price inflation. So that can only be accelerated. And that's a key reason why it's so important that Lemonade and others put through rate increases. We saw in an earlier slide that in recent quarters, the average rate increase has been around 15%, which kind of matches to this 15%. So it's worth kind of keeping in mind that just because we see rate increases, it doesn't mean that loss ratios improve necessarily. There is a minimum level of rate increases needed just to stay up with inflation. Like if we are seeing loss costs increase by like 15% per year, then really we need rate increases of like 20% per year, because implicit within that is the loading for profit and the loading for reinsurance and a lot of other things, you know, covering fixed overheads. So we need to see rate increases continue to come through to stay current with inflation. A little bit here on claims and reserving. So pet insurance is a very short tail class of business. In many cases, claims are settled at the point of the claim being like at the point of the vet's bill being paid. So for Trupanion, for example, they have a software that's embedded within the veterinary technician's space. So as the customer is paying that bill, they will just say to the vet, yeah, I have Trupanion coverage, and the vet will select that from his computer and just pay that claim instantly on behalf of Trupanion. So I don't know how Lemonade's claims work necessarily, but I would imagine it's quite similar, or it will be automated in some way. So it will be a very kind of frictionless claims process. And what that means is that we really wouldn't expect to see open claims. Like claims will be submitted and paid like instantly for almost all cases. Clearly there will be some technical or difficult claims that insurers have to look into manually, but on the whole, this class would have a very short development tail and claims would kind of be settled very quickly. And that again helps with capital and predictability of the class of business. Okay, let's start to put things together. We've talked about a lot of theory, but what does it actually mean to us as Lemonade investors? So I will use a few key assumptions. So firstly, let's look at Lemonade in 2030. I'm going to guess 50% growth per year. I think this is actually a very conservative estimate, because we know that the market growth in the last 5 years has been about 25% per year. And we know from the Lemonade Investor Day presentation that Lemonade's own growth has been about 100% per year. This is just one model. Also, I'll come on to this a bit later on, but I believe that a significant amount of the general catalyst investment into the business is going to go into the pet business. So I think, you know, we could make any set of numbers. I've gone with 50% just for an example, but I believe it could be actually quite a bit higher than that. It could be like 75, 80% per year. But just for an example, let's go with that 50%. Then we will work from the current $500-ish per premium per customer. But let's assume that we need a further 15% rate increase to on-level premiums, and then any further rate increases from that point on will just be to match underlying claims inflation and frequency trends. We will use the current cohort ultimate loss ratio of 60%, which is from the investor day, and I think that's reasonable because we know that in the last few months we've had about a 15% rate increase be put through the portfolio, and so that would affect the ultimate loss ratio over time, and it just makes it feels like a reasonable number to me. Okay, so and we'll start from the Q3 23 customer count, which is a known data item of 200,000 customers. So how does that come together? So just doing some math here, if we grew the policy count by, and actually this is probably 2029, sorry, not 2030. We're at the start of 2024. So I guess start of 2030, let's say 6 years, 5 years time, whatever, whichever year it is, let's just go with these numbers. So 200,000 times 1.5, so 50% growth per year to the power 5, that would give us the 2.3 million customers. And again, we will use the premium per customer of $500 times that future rate increase, and after that we'll just assume that any further rate increases offset inflation. So you could think of this as like a 2024 estimate, so I'm not necessarily inflating for the nominal premium increases to 2030. And we'll go with a 60% loss ratio. So insurance claims would be 0.78 billion. So premium 1.3 billion and claims of 0.78. Expenses, assume 15%. This could be a little bit light for 2030. I think we could still be seeing some significant investment into the business. So maybe this is higher, but these are all made up numbers anyway. So it's just for an example. But I think this is possible that we could get to 15% by 2030. So all of those numbers come together and we get a free cash flow or a pre-tax profit for the pet portfolio of 0.33 billion. Now, bear in mind, this is an extremely simplified example. I didn't want to really get into get too detailed on future profit projections, but I might do that elsewhere, and other people have done that as well. So note that there's a few other factors at play. For example, synthetic agents could still be at play by 2030, and so if that is the case, there's an implication there of the part of the profitability that would go to synthetic agents, also the reinsurance structure. But we know that although in this case I've assumed that Lemonade retains all of the underwriting profit, there's also ceding commission which they get on any proportion of the business that they cede to the reinsurers. So I've kind of considered that those two largely offset, and anyway, it's just an example. So this is just to kind of demonstrate our starting point. So pet premium per customer of $512 is actually quite high. These numbers are all from the Q3 2022 presentation that was made at Investor Day. And I did some, I kind of gathered up all of the data items I could find. And these are, this 512 is from current Q3 23, and that's from the rates filings that Lemonade has made. The renters premium per customer $160, that comes from the Investor Day number from the in-force premium of $223 million and 1.4 million customers. So just dividing those two out, we get around $160. Now, worth noting this, actually we'll come on to that in the next slide. Just looking at these numbers, the life and car numbers, these were not split out at Investor Day, but we did get the home. So this is renters 223, home 149, and pet 110. Those three were stated, and so from the total $609 million that we had at Q3 22 from the shareholder letter, we can deduce that the car and life elements are some mix like this. I've guessed 40 for the life and 87, but either way, by the math, these two add up to this bit of the chart. 87 plus 40 has to be the life plus car. So next slide. So this is from the Q3 2023 shareholder letter, and focusing in on the bits in yellow. So in recent quarters, we've seen LTV, which is the long-term value of future cash flows from the policy sold, divided by CAC, which is the cost of acquiring customers, of 4 and higher. And the letter says that the growth acquisition spend has been modest. Systems are used to cherry pick the very best opportunities, and new business we're bringing in is high quality and profitable. And I've just got a feeling from everything that we've heard and seen over the last couple of months, like 4 months, let's say. So at Investor Day, Maya kind of made it clear that the team had gone through every single home policy and they'd re-underwritten it, and they'd cancelled or they'd non-renewed a number of policies, and they'd done some significant rate increases and what we call underwriting actions on that portfolio. So I have a strong sense that the home portfolio and also the motor portfolio are, the team is kind of taking their foot off the accelerator on those two. And it makes me think that they are accelerating on pet especially. And the reason for that is that renters is already quite a mature market. There are some, the economics aren't quite as good. Like the premium per customer is a lot lower, so it makes it difficult to make that a really big driver of profitability. And also there's already a lot of customers. I think the guys are focusing on pets. So coming down to here, again, this is from the Investor Day presentation. This is for home. Sorry, this is not home. Ignore the screen here. This is renters. So ignore the fact it says home. This is renters. $223 million of in-force premium, and the LTV divided by CAC number was 3.15. And coming down here, again, I've not updated this slide. This should say the home numbers. This is 149 million premium as of Q3 22 for home. But notice this is the LTV divided by CAC number, and it's quite low. We want this number to be as high as possible because CAC is what we spend as a company, and LTV is the long-term profit that we kind of accrue back over time. Then dropping down to the next slide, again, I've missed off the title here. This is Pet. So Pet had 110 million of in-force premium at Q3 22, and the long-term value to CAC is like 3.8. So that's the highest of all of the products. And remember, in Q3 23, the team made clear that the LTV divided by CAC number they were seeing was 4, or just over 4. So it kind of makes me think, well, it has to have quite a big element of pet. People have been saying, oh, maybe the guys are weighing into home, but I don't think so. I don't believe they're doing that. I think the guys have put the pedal to the metal on pet. They have access to the same data that I've looked at in this presentation, and I think it's obvious the opportunity that's there, and I believe that they will be absolutely going for those young pet customers. Okay, so a quick note here on capital requirements. So we know from earlier in this video that the capital requirements for pet will be much, much lower than for home and motor. This is a slide from the Investor Day presentation, and a more recent number was 7.1. But what this says is for every $6 of premium that the company sells, so every $6 of in-force premium, they have to hold $1 of capital. And the more recent number from, I believe it was Q3 23, was 7-1. But considering just the pet portfolio on its own, from the kind of work that we've already done in this presentation, we know that the capital for pet has to be much lower, right? So maybe it's like, $10 of premium per 1 of capital. It's certainly much lower than for home. So that is another factor in the company accelerating growth into pet, that with limited capital resources, they will want to maximize the free cash flow with respect to capital, and also, reduce the risk of doing that. So let's think about the bigger picture now. So not specific to 2030 or any specific year. Let's just think about the big picture here. So at the moment, if I type into Google number of households with pets in the USA, I see 87 million. So let's just say that, over the next few years, that goes up to 90 million, which feels like a pretty conservative estimate. Then if we work through some math here, so let's say there's 90 million households with pets, assume 25% buy pet insurance, and that's reasonable because in the UK, that's the market penetration we have, a much more mature market. Let's assume that Lemonade captures 20% of the total market. I think that's also a reasonable assumption. Sorry, actually, this should say 25%. I updated my slide a bit later. So 25%. And then the math comes through that Lemonade would at this point have 4.5 million pet insurance policies. Let's go with a premium per customer of 600, loss ratio of 60, both reasonable assumptions in my opinion. And on a very simple basis, there are many more factors at play obviously, but on a simple basis, that would give a profit of 4.5 million policies times $600 premium per policy, and then times the 1 minus the claims loss ratio minus the expense ratio of 0.15, and come through to $675 million of profit per year, and that is just for the US pet. So you can imagine why I'm so excited about this company. This is just one product in one country. Like, pet can be rolled out to every other country that has got significant pet ownership, like the UK, Eurozone countries, Canada. But just for the US pet market, these numbers, and it's just made up numbers, an estimate. But let's just say this comes through and we see $0.65 billion of profit per year. Well, the current market cap is $1.2 billion. So you don't have to be a math whiz to work out that the potential for this company is quite high. Worth noting again that this set of calculations, or just guesstimates, let's call them, ignores the profit that's ceded to the reinsurers. But on the flip side, there is ceding commission to compensate. And remember that for the business that is ceded to the reinsurers, Lemonade receives ceding commission, but they don't have to hold capital. So overall, I've just ignored that factor. Yeah, we could get really into the details and work things out more, on a more granular basis, but I don't think we need to. So that is that's where we're headed. Big profits for pet, I believe. I wanted to share with the community a little bit of math behind, my understanding of the pet portfolio. So I'm going to talk through some mathematics that we could use to look at things, and some assumptions. Again, we've been through most of these, but number of pet customers 200,000, frequency of each claim per policy. I'm just having it 30%. It's not a number that we know, but I have seen similar statistics elsewhere, for example, in the UK market. Severity, I'm just going to say for now this is 1250, and I've kind of derived these. There is some substance behind these. And then average premium per customer, $500. Again, we've seen that elsewhere. Okay, so coming down, what is the expected claims experience? So we can use a frequency and severity model to look at this. So frequency is just how many claims do we get. So we talk about an exposure measure in insurance work, in actuarial work especially. So exposure in this case can be thought of as just the number of customers, or the number of policies, right? So 200,000 would be our exposure measure. But for each one of those, for every single customer or policy, let's say, what is the chance that we get a claim over a 12-month period, for example? Well, if that's 30%, then that is our frequency. And then severity just means how big is each claim on average. And in this example, we're going to say that frequency is 30%, and severity is $1,250. So if we have got 200,000 pet customers, then the total expected aggregate loss cost would be the 200,000 customers times 30% frequency, and then times 1250. So that comes through to $75 million. So Lemonade targets a 75% gross loss ratio, right? So if we use those parameters, the aggregate loss cost expected, we would say, is $75 million, and premium would be the 200,000 policies times 500 premium per customer, so 100 million, and then that gives the expected gross loss ratio of 75%. So the math kind of comes together, and it's kind of quite good to think in those terms, I think, rather than just think loss ratio. What actually goes into a loss ratio? Okay, so let's introduce the variance. So we are modeling the claims frequency as an independent, a set of independent random variables from the Poisson distribution. Again, this is a very reasonable assumption to use for claims frequency, especially. The actual loss amounts, maybe they could be thought of differently, but on a simplified basis, let's just say that the aggregate loss costs can be modeled by the Poisson distribution. The Lemonade team would have access to data which would allow them to kind of fit these distributions to the underlying claims data. Clearly, we don't have access to those, so let's just imagine that we did, and if we did, we'd be able to fit some distributions and test whether the Poisson would be a good fit to the aggregate loss costs. And a quick note, we buy reinsurance because of the variance. If we did not have variance, then we wouldn't need reinsurance. We would just sell a load of policies and that would be fine, but we do have variance. So even though our best estimate for the expected number of total claims is 60,000, well, we could see a different number. We've been through most of the math behind this already. We could see 50,000, 57, 68. There is a non-zero probability of those outcomes. And I won't go into this. This video is already too long, but this is the Poisson distribution. Math guys, I just wanted to put it on screen so you can see that. It is worth just noting quickly, how do we derive the parameters for that Poisson distribution? So this is the probability density function. That's the probability that x equals x, or in our case for the aggregate loss costs, s equals s. So it's just saying, like, what is the probability that aggregate loss costs are, let's say, 76 million or 77 million? We can estimate this. So we write down this likelihood function, and that's this. And then we take the log of the likelihood function, and that makes the differentiation easier in later steps. But this is the math. This is kind of what degree level math looks like for statistics. And then we take the log function and we take the partial derivative with respect to lambda. So that's just saying this is the partial derivative of the log likelihood function, and this is what we get. And then we set the PDE, partial derivative equation, equal to 0, and we solve for lambda. And then when it all comes through in the wash, what we come up with is lambda equals 1 over n times the sum of the xj's. So what that means in the real world for people that are not math guys is we just add up all of the claims over a year. So for example, we said we sell 200,000 policies. Let's just say that we get 60,000 claims over the year, and average is 1250. Well, total loss cost there would be 75 million, and if we divide by the number of policies, then we can get an average loss per claim. So that's what this means. Okay, so who cares? Like, why do we need to know any of this? Well, you don't, to be honest, but it's quite an interesting way to think about things, because we've already talked about the convergence to normal distribution, so I won't go back into that, but we can use the normal distribution if we can establish the parameters for our distribution, so the mean and the variance. Then we can use the normal distribution to estimate particular outcomes. So again, here's the normal distribution, and we want to know what's the expected number of claims. So on this example on screen, it's 50. But again, we want to know what's the probability that we have like more than 55 or more than 60, for example. Okay, so limitations of Poisson is that the variance for the aggregate loss distribution is quite often, well, it would be much bigger than the mean. So that is a limitation, but we can overcome it by using a model called the over-dispersed Poisson, and we'll just assume that the variance is some function of the mean. So like maybe it's 10 times the mean, for example. And again, Lemonade or an insurance company would be able to test using the claims data to derive the variance parameter. And once we have a good estimate for mean and variance, next slide. So again, what we can do with that is that we can say, well, what is the probabilities that we want to use? So again, this is just an example. So 200,000 policies. S is the aggregate loss distribution, which is N, number of policies times expectation of X, which is the average claim size. And we use these parameters. So let's use an over-dispersed Poisson model with variance of S equals 1,000 squared. It's just a made-up number. Don't use any of these. These are just made up for an example. And our question is, right, if we have got a best estimate loss number of claims of 60,000, what's the chance of getting more than 62,000 in a year? So these are the kind of these are just example parameters. Using that, we can use the normal approximation, and this is kind of the gist of why all this math is important, because if we have got good estimates for the mean and variance, we know mathematically that things converge to a normal distribution, and the normal distribution is a well-established, well-known distribution where we can look up values, right? So working through the math here, we need the probability that the aggregate loss cost is more than 62,000. We use the mean and the variance in the normal distribution, subtract 60,000 from both sides, and then we divide by the square root of the variance, which is in this case 1,000, because the variance is 1,000 squared. And so what we get is the probability that Z0 sigma squared, which is the standard, is called the Gaussian distribution, standard normal distribution, the probability that that is more than 2. And we can look that up in a table to say, right, that chance is 2.5%. And so when we think about the loss ratio, it's important to just bear in mind always that it's a random variable. It's not a fixed number. So that's just some math that I thought might be worth sharing. And here's an example for severity. This is not really for pet. This is probably more like home or motor. This is called an asymmetrical distribution. So it's got a long tail, so you can see that the mean is somewhere around, 6,000, for example, but it's possible to get claims way up on the scale. And again, here's another severity distribution example. And if we had the data, we could, this is what we would get. We would fit all of our claims data to a distribution like this, and then get the mean and variant parameters. Okay, so in summary, this is the end of the video. Lemonade has got a huge opportunity in pet. I believe that pet and renters will be absolutely gigantic cash cows for decades to come. I think my personal view is that home and motor will be kind of on the back burner for a little bit, and I think that Lemonade are going to go absolutely pedal to the metal in growing the pet and renters portfolios, and that the free cash flow will come from there. Bear in mind the General Catalyst deal, where Lemonade is funding acquisition of customers. It makes a lot of sense for them to go after pet and renters, and for the home and motor to come later on, as those young insureds with pet and renters policies, as they grow with the company, they will kind of transition onto home and motor naturally over time. I really want to emphasize that everything in this presentation, well, the math was not made up, but the Lemonade specific examples were made up. and nothing here is financial advice. And I'd encourage you to do your own research and investigate the company further if you are interested in it. Thanks for watching. Again, please hit subscribe, and I hope to see you in another video very soon. Thanks for watching. Goodbye.